Hello and welcome to this Investonomics webinar on Union Budget 2023 with Aashish Wakankar, the founder of EquiPoise Capital Management Limited. Mr. Wakankar has a vast experience of over 30 years managing portfolios for Deutsche, Kotak and SBI funds. Welcome, sir. Good afternoon to you.
Good afternoon, everyone, and thank you and the team ICICI Securities, ICICIdirect for giving me this opportunity.
We're very glad to have you here. Thank you so much for coming. First off, I'm going to take your view on how you perceive this budget. How do you think this budget is, and what do you think it will do for the economy on whole?
Yeah, so I guess many would have heard about the budget and the innumerable analysis, but I'm just going to stick a few points which I would like to highlight as far as this budget is concerned. I mean, in the run-up to this budget, I think there was a lot of expectation around it and a lot of anxiety. And people were wondering whether there would be some impact on the taxation, particularly the capital gains tax, and whether, given the fact that we are headed for a election year next in 2024, whether some freebies would be given. But if you look at it, this budget has done nothing of that sort. It has remained steadfast and absolutely in line with the way the previous budgets have also been presented by in this country ever since 2014. The idea is to focus on performance. The idea is to focus on growth, because it is that itself which leads to jobs. Because you're all worried at the end of the day, what is the situation for jobs? Whether new jobs will be created, and new jobs can only get created if there is investment. Without investments, there can be no jobs. And we've seen that in the year 2009, as post global financial crisis, globally, and at that time, unfortunately, even India followed. We gave a stimulus which was more, consumption-led, and what we saw was massive amount of inflation, and the economy came crashing down. This time around, post the COVID crisis, the world again started giving a stimulus which was consumption-based, but this government deviated from there, learned its lessons from the past, and went through a more difficult and more time-consuming but long-term growth-oriented path of investment-led stimulus, and it focused on protecting the weaker sections of the society through food, the MSME sectors by the loan moratorium that we saw, and getting on the capital expenditure. So if you look at it, the results are there in front of us. We are the only country in the world right now which is growing at a speed of around 7%. This is the only country in the pandemic which has seen tax to GDP ratio go up. This is the only country which has seen debt to GDP go down. And how? I mean, we've seen the debt to GDP. Maybe just take a look at even the external debt to GDP. Both these have gone down significantly by around, say, the external debt to GDP was close to 24%. It's gone down to 19%. So on all parameters, the government took the difficult path and has delivered. So if you see, capital expenditure has gone up. We've all seen that, of course. It's gone up against the normal 25%, 20% growth, which looked like benign for a country like India. We've seen a 33% growth. Just to give you a number in perspective, the capital expenditure today, that's 10 lakh rupees that is proposed for the financial year 24, is greater than the capital expenditure this country has incurred from 1971 to 2005. And if you look at it, in just 2019. Our capital expenditure was barely, 3 lakh crores, which gone up to around 10 lakh crores. So, from a job creation perspective, capital expenditure, which is key. But for jobs, I mean, you create the environment for jobs, but the jobs need skilling. So, some of the softer things that I saw in this budget, and I saw the vision that document communicated, and I'll give you what I mean. 157 new nursing colleges have been announced in this budget. Now, we all know that the world is getting old. There are exceptions in this world, which is like India, which is still getting young. We are adding, youth to the population, but it is the youngest country in the world in terms of the working age population is concerned. But globally, look at say Japan. We all know, but even China and many of the European countries are getting old. What do they need? The old person is either in a hotel or in a hospital. So the two things, hospitality or hospital. These are the two things that are needed. So 157 new colleges, nursing colleges, even if there are jobs outside the country, this government has, focused on not just creating jobs for India, but if there are, because we are a large country, we cannot say that, people will, get educated and stay inside the country. No. At the end of the day, we are open to even creating skills so that the world benefits out of our capabilities. So we've moved over there. Another focus that this government, this budget showed was on tourism. Now, tourism has been announced as a thrust area by this government. What does tourism lead to? I mean, when you have capital expenditure or investments taking place over there, you will have capital formation, you will have facilities, because tourism is the largest employment generator. So reduction in foreign exchange outflows. People go outside the country purely because they find tourism outside the country, more convenient and also cheaper.
Yes.
Then many of the times people go to Far East and the Middle East also, because the comparative facilities are at a lower price point. But if you create infrastructure, you create investment that it makes these costs come down, you create facilities, I think that will ultimately lead to economic growth. So all focus on direct as well as indirect way of creating employment. When I say direct and indirect, means capital expenditure will have its lag effect, but once the jobs are available, to create skilled labor to be able to grab those, which is also something that this budget has focused on. So in all, I think this is a budget for everybody. It's tried to cover almost all and it's pressed the right buttons, in my opinion. Ease of doing business is an indicator which, foreign investments, so we are focused on getting foreign investment inside the country, FDI. So to get foreign investment, some of the parameters people look at, and there is an obsession for these ranking and these indices globally. So ease of doing business to go up. Some 39,000 compliances have been done away with. 3,400 provisions have been decriminalized. So all in all, I would say the huge effort done on the softer as well as the harder side. And you know what? I look at the budget from not just the numbers perspective. I mean, yes, capital gains tax has been left untouched. No change in STT. The rebate has gone up from 5 lakhs to 7 lakhs. Yes, that will lead to consumption. All these numbers are fine. At the end of the day, we as investors in the markets are long-term oriented. And long-term is not 3:30 p.m. Long-term is 2 years, 5 years, 10 years. So if one has to take a look at, making an investment, where are we headed? 5 years from now, 10 years from now, that India, thanks to this capital expenditure, thanks to these initiatives taken, where it will be, and are we ready to grab, or are we going to look at people from outside to come over here and, grab this opportunity? So all in all, I think the more important point, in my opinion, than just the numbers of the fiscal deficit discipline, we are on the glide path. Everything that the market was looking at, foreign investors were looking at, have been touched upon. I am going to touch upon those aspects because that's my investment philosophy. The investment philosophy that we follow at EquiPoise Capital is very simple. We look at identifying and investing in tomorrow's leaders. We look at identifying companies which will become a part of the index tomorrow, or which will be part of tomorrow's index. We look at change at the margin. I mean, on the various seminars and calls that ICICIdirect has given me an opportunity to speak, I have said this: our core philosophy is change at the margins. What is change at the margin? I have explained: change in leadership, change in capital expenditure, change in some additional capacity that has been built, change in technology, change in the business environment. If you look at it, the budget over the last 3, 4, 5 years that this government has presented fits exactly. And in my opinion, India is that stock, or India is that investment whose time has come. India is, we keep on struggling. Government makes lots of efforts in trying to see how India can be a part of various bond indices so that foreign investment can naturally come inside as a function of, passive investments that are a major proportion of, investors. So India is, I think, getting ready to naturally be a part of tomorrow's indices. And that exactly fits in, our core philosophy over here, which is change at the margin. You know what? I'll stop over here with my opening remarks. And if there are any questions that you or anybody else would have. But by and large, I would say everything that the market had expected, I had expected, or many of the investors had expected, have been done. Look at the softer aspects of the budget. Don't just get obsessed with the hard numbers that have been given, that everybody knows are there. But the impact of whatever initiatives have been taken will have a far-reaching effect, which will start showing 2, 3, 5 years even from now.
Okay, thank you. So I think that was very beautifully articulated. And yes, I think you're very right, and the government has also said so. We're in Amrit Kaal, as the finance minister said during the budget. We've hit a golden era. India's economy is robust. It's poised to grow from strength to strength now. But even despite that, I mean, despite us being one of the strongest performing economies there is in the globe right now, we saw the worst FII outflows in the past 7 months. Do you think with these new policy announcements that are made, all of the change that has been happening, do you think this is going to revive FII interest now?
In the long term, yes, the FIIs will have to take a look at India purely because this is the only economy which is growing at 7%, 6.5%. And I have to say 6.5% is still on the conservative side, given this government's, peculiar. Just take a look at the growth in the tax collection. Just take a look at last year's number when government had estimated that this economy will grow at around 11%. But what we saw, nominal growth was way above 15%. So conservatism is the part of this and of this government. And as the numbers start unfolding, investors see at the end of the day, there is a fixed amount of money that is there that is chasing returns. At the end of the day, let's be dispassionate about everything. You and I, being Indians, we might like to feel that India is the greatest country and India is the only destination. No, money is chasing returns. As long as you are performing, as long as you are generating returns, markets or in foreign investors will take a look at. Let me tell you, my entire career before I started EquiPoise Capital has been in managing foreign funds. I have never been a fund manager for any domestic mutual fund. I have been a fund manager for various foreign FIIs, that is, or FPIs, SEBI registered, and I have managed their money. So I know exactly because I have dealt with them in Japan, across the world. I've managed their money and invested in Indian markets. One, they have patience. They are interested in returns, but not outlandish returns that Indian investors expect, and they understand, exactly what is happening at the ground level. Because bulk of them who come from developed markets or the developed economies have seen themselves. I mean, people who are in their 50s or 60s who have seen their own economies go through the cycle. They are watching India. The only thing that we are seeing is, and in fact, in one of the last calls, I had mentioned, don't look at FII as one animal, FPI as one animal. FIIs are made up of multiple, creatures. So they can be global markets funds, they can be emerging markets funds, they can be ETFs, they can be index funds, they can be sovereign wealth funds, they can be pension funds, whoever. The problem starts when you have money. And then, of course, there are those foreign funds which are India dedicated funds. Now, those funds do not have any compulsion. But those funds which have a global benchmark, and you have a situation wherein there is an outflow because of risk off, because of interest rate hike. When you see outflows, you cannot have because they're ultimately benchmark. People have a discipline. In India, the approach is by and large bottom up. Globally, when these large funds have a discipline of keeping the benchmark in mind. So when you have, for example, India's weight in the emerging markets, MSCI emerging markets is say 13%. You say, what, India is doing 7%. I'm not going to get out of that. I'm just going to remove the other ones, the other economies which are doing worse. But that creates a lopsidedness. So even if fund manager doesn't want, he has to get out. These kind of, winds crosswinds that keep on flowing result. So even in a But if there is a smaller allocation of 5%, when I say I'm not going to touch India, I'll sell off everything. That creates a lopsidedness in the whole structure. So foreign funds are well aware of this. They're watching the macro numbers. They're watching the intent of this government. 33% growth over a previous year of 25% growth over the last, say, 5 years of systematic 30-40% CAGR growth that has been seen. Everything is in front. It's just only a matter of time when that starts flowing in, because budget is behind us now. The only thing that is there for us to look at is the earnings numbers, which will flow through. When you look at earnings, markets, investors, we all are slave of returns. Returns are basically the earnings numbers, the growth numbers, earnings growth at corporate. So whether there will be a blanket investment in a certain sector, whether there will be a blanket investment in the across the index, I have no idea. But there are those interesting opportunities within those companies which will grab this growth coming their way. It will be shown in their earnings growth. And investors, foreign investors will have to come back. I mean, there's absolutely no way.
So as I understand it, there seems to be a certain lack of maturity in terms of Indian investors. All of us, we seem to be a little impatient waiting for returns. And all of us need to understand that any growth takes time. We're just at a basic stage right now of reaching a very developed economy. So when you say long term, sir, if you put that in time perspective, how many years, if an investor is investing today, how many years should he actually hold on for and wait to reap the benefits of what's been sown today?
So, what long term is something that from a capital gains perspective is defined as more than 1 year. But we typically look at our portfolios and say, one should be looking at 3 to 5 years of horizon as far as investment is concerned. But I think it's too much of a concept which needs more understanding, in my opinion. Yes. Ultimately, investments have to be aligned with your goals. Investments cannot be in isolation. So the instrument that you select for investment and the longevity of that investment has to be aligned with ultimately what your goal is. So for somebody who is in his late 20s or early 30s and who is saving for probably his retirement, his children's education, or his children's marriage, or even for his holidays, his retirement, sorry. So the alignment is different. The whole concept has to be of staying invested. And fortunately for all of us, the beauty over here is we are blessed to be living in a country like India, where the growth is just about, starting to happen in a very exponential way. Now, there was just a report the other day by a foreign think tank, which said that, by 2030, India will be around $10 trillion economy. There was one more, from the Big Four, which said that, by 2047, India's economy will be, say, $26 trillion. All in all, I'm not going to get into that number. It's a simple mathematics. If somebody can extrapolate the number on the basis of, say, 7% or 8%, nominal growth and inflation that is in the adjusted limit, you will get that number. That's no big deal. But fortunately, we are living in that country. So as long as the policy stays, the course, I don't think by now there is any reason for anybody to worry, because India's politics has also understood one thing, that growth and jobs matter. So whoever comes to power, he is not going to tamper with this. Maybe the pace can move up and down slightly. That's different. But by and large, people have understood that these are crucial things. And over the last 8.5 years, this government has demonstrated performance matters. Freebies don't matter, because throwing freebies, we've seen, and what you go to the people is with your report card. So long term, in my opinion, is something that I say should be aligned to your goals. Capital gain, from a taxation perspective, 1 year is fine. From my perspective, I say anybody investing in our portfolio should have at least a 3 to 5 year horizon. But let's get out of this capital gains. Let's get out of this portfolio. I am saying, as an investor, I am also an investor at the end of the day. As an investor, how should I be looking at it? Simply align it with your goals, and investing will be difficult, will be easy. Otherwise, what happens is you keep on looking at market going up and down every day. then asking what will happen today after this budget. Who cares? Who knows? I mean, nobody knows that. If anybody wants to say that, it's fine. It's up to them. But if you align yourself with your goals over the long term, we've seen how markets or equities have, the returns that they have generated over the long term. And they've beaten all other asset classes. So, in line, long term is that alignment with your goals.
Okay. So you spoke about us as investing in India's growth story, about there being a lot of ease of business. Also, there was this 9,000 crore infusion in the credit guarantee scheme for MSMEs. Do you think with all this, we should be looking at mid-cap and small-cap sectors, seen as, they would possibly be the ones to fuel this growth here on forth?
See, at the end of the day, the philosophy that we follow over here, and I mentioned that, is to identify tomorrow's winners, to look at stocks which will be part of tomorrow's index. That philosophy work for everybody. I mean, as an investment, method, I would say that that's best handled by the respective investors, financial advisor or financial planner, because there is volatility which is attached to any asset class. And if your goals are not aligned to that, you would be stuck on the wrong side. So, yes, at the end of the day, forget the investment that is taking place specifically, but an economy at the end of the day is not just the top corporates, but the backward and forward integration that happens through the MSMEs. So if you look at the PLIs are maybe to a certain large corporates or some of the top beneficiaries. But if you look at the returns filed or the credit growth that is taking place and who is borrowing the money, you can clearly see today that the MSMEs are leading the credit growth. They are contributing significantly in the incremental credit growth that is there. So what does it mean? It means that the various initiatives with the policies, the steps taken by RBI, the government are aiding them. Plus PLI, they seem to be benefiting from that as well. So logically, the sectors that you mentioned, mid and small caps, will do well. And I still say that this is a stock pickers market, but should the portfolio be only aligned to mid and small caps? Well, it should be aligned to your goals. So while I agree with what you said, I fully agree with what you said that the MSMEs, I will not get into mid and small. MSMEs stand to benefit significantly, and I see the effort of the government, because at the end of the day, they are the ones who create jobs. And there is an effort to uplift them. And yes, they have the protection that was given during the COVID. They have stood up. And they will benefit, but the investment aspect of it, when you say I'm going to invest in mid and small caps, whether through direct equity or through mutual funds, that aspect, the allocation aspect of it, is something that is best done sitting with your planner, advisor, and aligning it with your goals. You don't want to be in a situation where you're investing in a mid cap for next year's holiday abroad or anywhere, and then you have. So you had COVID next year, God forbid, but if there is COVID, then you will be stuck.
Absolutely. So goal-based investing is absolutely important. It's something all of us need to do. And thank you so much for all your views. Any other advice you would like to give our viewers, or we can wrap this up?
No, as I said, this budget basically talks of India as an idea, India as a stock. And I say it's a stock whose time has come. I can only say this, that, I wish I was in my 20s, 30 years younger than what I am, because exciting times, because the efforts, the initiatives taken today are definitely going to, for the younger generation, we're going to see a completely different India tomorrow. And I would just say you're lucky. So stay invested, keep the faith. I think all the right buttons have been pressed. And at the end of the day, while investing, keep long-term in mind, align your investments with your goals, with the help of a partner.
Thank you so much, sir. I'm sure your words of wisdom have been ingrained somewhere in at least a few 20-year-olds, and we'll take your advice very seriously. Thank you so much for taking the time out to be with us. Thank you, sir. Good.